Good morning, everybody, or afternoon if you're on the East Coast. Welcome to BackNine's webinar, Long-Term Care Awareness Month. November is National LTC Long-Term Care Awareness Month. My name is Ilana Fox, and I am the Long-Term Care Brokerage Director here at BackNine, where we work hard at offering you simple and easy solutions to help insure your clients. I have been in the long-term care solutions planning market for over 15 years, and what has remained constant is that the long-term care solutions keep changing. The carriers know that long-term care is a real risk, and they will need to be accountable for these risks. So what I am looking forward to offer you this morning is to share with you what I have learned to be one of the most plausible answers to offer your clients to address their needs and concerns for a long-term care solution. My guest this morning is James Romero. He's Marketing Director at One America. One America offers one of my very favorite solutions for long-term care coverage with their products in a series called Asset Care. They have Asset Care 1, 3, and 4 that offer fantastic solutions unique to One America, and I believe that these solutions will resonate well with you and your clients. So James, please present to all the people out there your amazing asset-based long-term care opportunity for their clients' coverage.
Okay, great. Thank you very much, Ilana. And good morning or afternoon, everybody. Thank you for attending the call. And definitely going to discuss an amazing opportunity that you have in front of you with where we stand, as Ilana had described, with the long-term care market. But before we get into the details here, I just want to give you some background on who One America is. So One America is a financial services company and insurance carrier based out of Indianapolis, Indiana. Foundation has been around for well over 140 years. And we have excellent financials. So we're rated A+ with AM Best. We're AA- with S&P. Our current Comdex score is 95, and we've held that score now for the last 6 years running. So excellent financials. We're a mutual company. We have a focus here to make sure we're always in a good, strong financial position. We're in the top 8% of insurance carriers. We also, the A+ rating with AM Best, received that rating as an increase in May of 2011 during the economic crisis where a lot of carriers were being downgraded. So it just goes to show the financial strength, and that's an emphasis here at One America. Now, the opportunity is large by capacity here and where we stand today from a long-term care standpoint. Now, a lot of you on this call may not do a lot of long-term care. Some of you might. But it's not necessarily an easy subject. It's not something clients are always really open to, willing to discuss, or they're not just lining up to take out long-term care insurance protection. But I want to make it clear, by no means is that indicative of the need to plan for long-term care. Long-term care really is at its greatest need now more than ever. And that's just simply due to the fact of the baby boomers, the largest demographic in our U.S. population. Consists of the baby boomers who just started retiring a few years ago and are going to continue to do that over the next 11 years. So each day, 10,000 people turn 65, which means the amount of people in retirement is the largest it's ever been. Each day it expands even more. So you have this population base that have a shift in focus. They spent the last 30, 40 years where the focus and goal was accumulating, building, and saving, so that when they reach that point of retirement, they now can have enough money to live off of. So as a lot of those folks are now reaching retirement, there's a shift in focus. You're no longer in the accumulation phase. You're now in the preservation phase. How do I preserve what I've built for myself over my lifetime so that I can have an income that will last me for as long as I live? And the number one risk to that plan would be a long-term care event, because the cost could be substantial. It could wipe out in just a matter of a few years what you spent the last few decades building and planning for. So give you an idea here. Based on average cost in 20 years from now, The average cost of long-term care is expected to be $174,305 per year. Well, men have an average long-term care stay of 2.2 years, so that's going to equate to $383,000. Women stay a little longer, 3.7 years. You're looking at just under $645,000 of an average care cost in 20 years. And then if somebody has Alzheimer's, that has an 8-year average stay in long-term care. So that would equate to, in 20 years, just under $1.4 million in costs. Now, let's keep in mind something here and put in perspective. These are just the averages. But how do you get an average? Well, if you take all the data from those that needed long-term care, some that needed less time, but there were others that were going to need for a longer period of time, you blend that all together and you come up with a number in the middle. However, just because, for example, the average for men is 2.2 years, does that mean any of your male clients that you present long-term care to, that their long-term care stay is going to be exactly 2.2 years? Well, we don't know that, right? There's a variable. They could be 1 year or they could be 6 years. They could have Alzheimer's where there's an average of 8 years. We can't predict what would happen with our clients in the future. So it's important to know you don't want to always just protect on the averages. We want to be able to put our clients in a position so that way no matter what the duration would be for long-term care, they're going to be covered and protected. We're going to discuss how we can do that with our plans here. A couple other facts here. If you reach age 65, you have a 70% chance that you will need long-term care. That's 7 out of 10 people that are going to need long-term care. That is a very high probability. So you think just based on that information alone that people would be more concerned and a lot more people would be making a point to plan for long-term care. But that just simply isn't the case. And one of the reasons why is even though we see this number of 70%, it's just natural that everyone's going to believe that they're going to be in that 30% of demographic that's not going to need care. That's just how we have to live our lives. So understand that risk-based selling and on these numbers and the probability, that's not necessarily going to motivate folks to move forward with a long-term care plan. So just want to take a point here and understand how we can motivate clients here with long-term care. So understand this, it's only about 6% of people in retirement that have a long-term care plan. Most people are going to have to rely on their own assets should they ever need long-term care. So you'll often get that. I'll just find a way to self-insure. I have saved enough assets. I'll find a way just to pay for that myself. So let's understand how that would work. So if someone ends up needing long-term care, they're going to have to go through their portfolio of assets, and there's probably going to be a resource that they've designated that they would access first to pay for their care. Now this could be a savings account, money market, CD, could be an annuity, could be an IRA, what have you. Any different type of asset it could be. But understand, here's how this would work. So say they have their designated funds for a case of emergencies or if they were unhealthy. Well, when they start to access that fund to pay for their care, no matter where these funds are being held, they're just going to be using their own money dollar for dollar, right? So in this example, they have a $125,000 reserve fund. And if they need care and they start to access this fund, they're just going to get their own money dollar for dollar, the $125,000. The company that holds these funds doesn't say, oh, we heard you're using this money to pay for long-term care expenses. Here's an extra 30% to help you out. That's not going to happen. That's not in the business of that financial institution. So with the average cost that we showed for long-term care, we could quickly run through this $125,000. Once you run through this reserve fund, then you start to tap into the assets that were not meant to be touched. Those were assets that were meant to be invested to earn a certain amount of return to last and provide that income to last you the rest of your life. As soon as you start tapping into those types of assets, that's when the retirement plan gets completely thrown off. And as I mentioned earlier, in a matter of just a few years, you can completely eliminate what you have spent the last several decades building and working towards. So understand that this is the situation most clients are in that want to self-fund, but they're in very grave danger here of having their plan blow up in just a matter of a few years. Fortunately, there is a solution, and there's a solution for these clients. Remember, this is what 94% of people in the population here in the U.S. are doing. They're self-funding, whether they realize it or not. And the great news is, with One America's asset-based solutions, not only do you have a solution, you can also assure your clients that they can continue to do what they're doing now. The exact same thing they're doing now. We can self-fund. However, what we say is this. Instead of holding this sort of designated reserve fund or go-to fund, instead of holding it where it's currently being held now with the current financial institution, if we just simply reposition and hold with One America, there are solutions out there that will provide immediate leverage so that your money has a higher value available should you ever need long-term care. And in this example, if we reposition the $125,000 with One America, their funds will have an immediate leverage balance of $250,000 available for long-term care. Now, understand this is not everybody's situation. Everybody's not going to double for. Whether you're younger or older, that will factor into how much your money leverage is. But just for this example, understand the concept of what we're speaking to here. So in this example, immediately, day one, as soon as they reposition the $125,000 with One America, it has an immediate value available of $250,000. So should they ever need long-term care, their money is now worth twice the value. So they're still self-funding and self-insuring their long-term care, but they're doing it in a much more efficient manner. They're getting more leverage out of their dollars to help make that last a lot longer. Now, a lot of people, if they knew they were going to need long-term care in the future, they would certainly do more planning. They would certainly allocate resources to cover for long-term care. But that's just a big hang-up. There's that question, what if I never need care? And if I didn't need care, I don't want to feel like I made a mistake with my money by positioning into a plan and never having to use it. Well, with this plan, you don't have to worry about that. Because if these clients never end up needing long-term care, the money's not going to go away. In fact, the $250,000 is not going to go away. If they end up passing away, the $250,000 is going to pay out to their children. So no matter what, this leverage value, this $250,000, is going to be paid out no matter what, either for themselves for long-term care expenses, or if they end up passing away, that would just be an amount that pays to their beneficiaries. So it takes away that big concern that use it or lose it, or I may never need care and I made a mistake with my money. Didn't happen here. No matter what, that leverage balance is going to be paid out one way or another. Now there's one last item here, and that's while we may allocate resources to a plan like this, we don't know our financial future and our situation may change. And we may no longer be in a position to hold these funds, the $125,000 with One America. Well, no problem. This $125,000 balance has a full return of premium at all times. So at any moment, if their life situation should change and they need to use this $125,000 for whatever reason, there's an emergency at the home, there's the major damage, insurance isn't going to cover it, and this is our only source of funds to pay for the damage, no problem. At all times, any moment, this $125,000 is fully available to you. So there's no waiting period, there's no vesting period. So whether it's 30 days later, 1 year later, 5 years later, at any time you have, at minimum, your $125,000 fully available, if not more, because it does grow, it does earn interest, and over time, it will actually be more than the $125,000, but at minimum, you have your $125,000 protected. So it's important to understand this. Now, while we may like what we're hearing here at the concepts, it may sound like, wow, we're asking for a lot of money here. We're asking them to pay for a long-term care plan that costs $125,000. That's not what we're doing here. What we're doing here is helping the clients do what they're doing now, but in a much more efficient way. Because remember, where they are now, they don't have a plan. And if they need long-term care, they're just going to use their own money dollar for dollar. So what we're saying is continue to do that now. Just instead of holding your money where it's at now, hold it here with One America. The money's never gone. It's always yours. You always have access to get that back. But while it's being held there, it has all these leverage benefits for long-term care, for death if you never use it, or Should you change your mind anytime, that money's always yours and fully accessible. So it's not really asking them to pay a lot of money. We're just asking them to not hold with the current company, move from company A, which is One America, and now while being held there, you gain all these benefits, and should you ever need your money back, no problem, always fully accessible to you. So once we understand that concept, that they're really just doing what they're doing now, but just instead of holding where it's at, we're holding with One America, then you start to get a lot of appeal. You say, well, okay, I really like how this works, but let me ask you a question. Is $250,000 going to be enough? What happens if I use up all the $250,000 and I'm still alive and I still need to pay for my care? What happens? Well, at that point, all of the benefits would have been used up. There's not any more benefits left. And now the clients have to get back to tapping into their own portfolio of assets, of those assets that were probably meant not to be touched. Remember, we want to keep them on their retirement plan. So instead of mitigating the problem here, we only delayed what we're trying to avoid. Fortunately, there's a hedge. There's a feature that we can add on here that I'd say about 85% of our plans will take this feature. And by adding this feature on, you will make this an unlimited long-term care plan. It would provide lifetime benefits, meaning should you ever need long-term care, and let's say you have a stroke or Alzheimer's situation where you're in care for 15 years, if you have this lifetime feature added to your plan, you would first go through the $250,000 balance for long-term care, and then once that's depleted, then this lifetime feature would step in and continue to pay unlimited benefits for as long as you live. For as long as you need it, it would never run out. It's an infinite duration of long-term care. This is an excellent feature that we offer. Lifetime benefits used to be a popular staple in long-term care back in the day. The carriers have not been able to offer lifetime benefits anymore. We're the only carrier that still offers a lifetime benefit. We have no means of ever getting rid of this, and this really makes it a very, very popular plan that we have. And we're going to discuss how that feature comes into play and how we can add that on to this plan. So let's take a look at the portfolio here. Alana mentioned asset care, and that's what we just were referring to in our diagram. So asset care is a life insurance policy with full access to the death benefit for long-term care purposes. So the death benefit is also a balance available for long-term care. Now there's 4 different versions of asset care that you see there, asset care 1, 2, 3, and 4. I want to simplify this for you. It's just one product. It's just asset care. All the numbers do are identify how we're going to fund the asset care plan. So asset care 1 is using a single premium of cash. Asset care 2 is using a single premium of an existing non-qualified annuity. However, for a disclaimer here, as you probably noticed earlier, Alana didn't mention asset care 2, and that's because we don't utilize this product very much. It's rarely ever used. The reason why is if a client has an existing non-qualified annuity, we have a portfolio called Annuity Care, which you see below. And these are newer products. These are much more efficiently designed to fund with a non-qualified annuity to create a plan, and we're going to briefly discuss that on today's call as well. So Asset Care 2, not very utilized as much. Now Asset Care 3, this is a very big product for us. This is using qualified money to pay for our long-term care plans. And then Asset Care 4, this is for someone that doesn't have a single premium funding source available, but they do have good income that they can make annual payments towards a plan. So that's also very popular as well. Okay, so here's an example of asset care and how this would work. Now this is based on a joint contract with 2 people on it, each age 64. Now I want to pause for a moment here that we're the only carrier that has the ability to do a joint life contract with long-term care benefits for both insureds and have full benefits for both insureds. There's some other carriers that do have a joint contract, but long-term care benefits have restrictions to the insureds. We're the only carrier that can offer a no restrictions, full accessible benefits for both insureds on the plan. So here's how it works. If you recognize these numbers here, again, based on $125,000, deposit that into the life policy and immediately returns a death benefit of $250,000. and that $250,000 is also a full balance available to use for long-term care. This is what we call your base policy. Now, you can access the $250,000 over a 50-month period, and that equates to a $5,000 a month benefit. Now, if you'll notice underneath the $5,000, it says per person. What that means is, since this is based on a joint contract, if both insureds need to go and claim at the same time, each person would have a full $5,000 a month available to them. So they would not split the $5,000 a month in half. Each insured would get a full $5,000 a month, so that would result in $10,000 a month in benefits being paid out. So what that would do is this $250,000 would deplete twice as fast. So instead of 50 months, it would deplete in 25 months. Now, we mentioned that we could add on that lifetime benefit. It's called a continuation of benefits rider. Now, you have two choices for your extension of benefits here. You can add on a benefit period for long-term care that matches your base policy. So as you can see here, you could add on an additional 50 months that would provide an additional $250,000 for long-term care, which would equate to $500,000, as you can see, the $250,000 life insurance death benefit, plus an additional $250,000 of long-term care, and that would equal $500,000 benefits. Or what you can add on, and what most people do, is just add on the lifetime benefit feature. This makes it an unlimited long-term care plan, will never run out, would provide $5,000 a month for both insureds as long as they lived. It would never have an end to it. And the reason why most people just go with the lifetime, not only because it takes away the worry of never running out of benefits, the cost is extremely favorable. The cost to add on this lifetime feature to this plan here is $1,239 per year. So this would be an additional premium. So this would be a separate additional premium from the $125,000. The $125,000 would just create your base policy, and then to add on the lifetime, it would be an additional $1,239 per year that the clients would pay to have this lifetime feature. You'll notice it says premiums guaranteed. This is a guaranteed premium, meaning this will never increase in cost. Cannot ever increase, contractually obligated to remain level. So that's a big objection people have to long-term care plans, is that those premiums, enforced premiums, can go up and have been going up significantly over the last several years. This is a guaranteed level premium that will never increase.
James, I want to, if you don't mind me interrupting, the nice thing about this continuation of benefits rider, that annual premium for the rider is tax, you can take tax advantages with that, because that's specifically for long-term care. You could use that as a medical deduction, correct?
Correct. Great, thank you, Ilona.
So that there's tax advantages with this.
Sure. Now, one other thing I want to clarify here, the $1,239, this is not the cost per person, so you wouldn't have to pay two premiums at this amount. This $1,239 is the value that covers two people for an unlimited duration of long-term care at $5,000 a month each for the rest of their life. So that's just over $100 a month to get a lifetime benefit that never runs out at $5,000 a month. So very, very affordable, and as you can see, that is why most people just go with the lifetime. Works very well. You can also single pay. So you get some clients that like this feature. They just don't want to have to worry about making annual payments to this plan. No problem. There's single pay options as well, so that way you can just have this be paid up front, and that way no more premiums would be due. Ages on this actually goes up to age 80. You actually now, it used to be the minimum age was 40, but you can go down to age 35. So ages are 35 to 80 that you can do this plan. In terms of the joint benefit, really is a great feature because with most carriers you have to do an individual policy, which means you have to split up your premiums, which is going to lower the benefit, and that limits the amount of coverage your clients can get. By having a joint plan, we can do one joint policy, pull all the money together, create one large plan for those insureds, add on the lifetime feature. That way we never have to run out, worry about it, the policy benefits run out. It would provide a lifetime benefit, and you get a much bigger policy to use at the insured's discretion here. So very favorable feature.
And in addition,
and it's not limited. Sorry, Lana. No, it's not limited to just spouses, just so you know. So it doesn't have to be a husband and wife here to do this. You can have parents and children do a joint policy here. The max age difference is 25 years. So you can have family members, you can have business partners, domestic partnership. As long as there's a definable insurable interest, you can do a joint policy on this here. So a lot of flexibility with the joint plan, not being limited to just spouses. That creates a lot of opportunity as well for the joint. Alana, do you have something you want to say there?
Yeah, I just wanted you to address, James, that if you do have that 25-year age difference between the joint insured, that you age average. So it's really to an older person's advantage to get that younger age.
Right. It's a joint equal age that will improve benefits. So let's say you had someone who's 80 years old who wanted to do a plan like this, and maybe at 80 years old, the leveraging isn't that great. Well, if there's a daughter or son that's within 25 years, you can add them on and make this a joint plan, and because we'll do a blended age, that's going to increase the leveraging. The money they're putting into this would actually leverage to be higher because now it's based on a blended lower age, so that can improve benefits as well. Correct, Alana? Okay, moving along here. Want to get through to the qualified money, because this is a huge option here for us. You're going to run into a lot of people that did a great job saving for retirement, but where they saved the bulk of their funds were in 401ks or IRAs. So they love this concept of an asset-based approach, but they don't have a large cash position, but they do have a great qualified money position, and those funds are what they'd like to use to do an asset-based plan. Well, we have a solution for them. Now, I just want to confirm here, even though we're using qualified money, the concept is all the same. So as you can see in our slide here, there's the base policy with a $250,000 benefit balance, 50 months of coverage, $5,000 per person. You can see you can add on the continuation of benefits. All that's the same. You can still do this jointly. This still has return of premium. Every single aspect is the exact same. The difference here is we're funding with qualified money. Now, we can't take qualified money and deposit that directly into a life policy. Can't do that. Premiums for a life policy have to come in as cash. So there's a very unique method that we use to be able to make this work. And how that works is, I'm using Hourglass here. At the top is a qualified annuity, and at the bottom is a life policy. So what we would do is a non-taxable transfer, either a trustee-to-trustee transfer or direct rollover of the qualified funds from wherever the money resides now. So we'll do a non-taxable transfer over to the qualified annuity here at One America. So now on our slide here, we see we have $125,000 moved over, non-taxable, and now it's here with One America. From there, we're going to take a distribution. We're going to take a distribution of $8,000 based on this on this number here. Now, that's going to be a taxable distribution. It is a withdrawal from a qualified account, so there's no way to avoid not paying taxes on a distribution from a qualified account. So that's okay as long as we let our clients know up front that there will be this tax liability on this $8,000 annually. We'll be okay. And then this $8,000 is deposited into the life policy. Now, the clients don't have to do any maintenance. They don't have to make this deposit of $8,000. To your clients, we're just doing a one-time transfer of the $125,000. We take care of all this maintenance in the background. We'll just send your client a 1099 for the $8,000 at the end of the year, and then they just take that and they will file it when they do their income tax planning. Now, we'll take this $8,000. It'll be a premium that deposits into the life policy, and in this example, it returns a death benefit of $133,000. To get your benefit balance here of $250,000, it will consist of two parts. It's going to consist of the remaining cash value in the IRA, which is $117,000, plus the life insurance death benefit, which is $133,000. You add those two numbers together, and that's where you get your $250,000 benefit balance. So the benefit balance on Asset Care 3 is a combination of your IRA cash value plus the life insurance death benefit. So how that would work, upon death, $250,000 would pay out to the beneficiaries, of which $133,000 is tax-free, $117,000 is taxable, right? It's all qualified money here, so it would be still taxable. Just like it would have been, the $125,000 would have been all taxable wherever it resided in the current IRA or 401k that the money was in before transferring. All of that money was taxable, plus it was only worth $125,000. As soon as we transferred this $125,000 into Asset Care 3, we added an additional $133,000 of tax-free dollars. So upon death, not only have we improved efficiency, we also added a lot more funds that would pay to the beneficiaries. And then same thing for long-term care. You'd have $250,000, of which $133,000 would be tax-free, $117,000 would be taxable. Now this is just year one. What's happening is each year we'll take another $8,000 distribution, another $8,000, another $8,000. So what's going to happen is the value of the IRA is going to decrease every single year. To offset that, the life insurance death benefit will increase every single year. The life insurance death benefit steps up every single year. So the IRA value is decreasing, the life insurance death benefit is increasing. This will help keep your $250,000 benefit balance intact. It does come down a little bit over time, but not much. So really what's happening over the years is each year, more and more of your benefit balance is becoming tax-free as it becomes life insurance. Eventually, after 20 years, all of the funds will have moved and shifted over to the life policy, and at that point, you have a completely paid-up tax-free benefit for death or long-term care. So it's a great way to utilize qualified money, minimize the tax liability on an annual basis, get the benefits right away, provide all the benefits of death benefit, return of premium, lifetime, joint protection, and utilize qualified funds. Now there's a link, there's a BrainShark video I'm going to send to Alana that she can send out to you. Because this is a lot to learn here, but after hearing it over a few times, it will definitely make full circle here and make a lot of sense for your clients. So I'll send that to Alana that she can send out that you can listen to.
Yeah,
it's just a short video that basically recaps what I say here.
Right. I will distribute it, and plus I'm always available for you to give me a call, and you have a specific case, or even we'll just go through a sample of how it works, how the tax-free implications. So it's an excellent product. I use it all the time.
Perfect. All right, great. Now lastly, just wanted to address Asset Care 4. This is a huge product, probably the #1 growing product here at One America. And just to recap what Asset Care 4 is, this is for those individuals that just don't have the ability to reposition a single premium, but income is good and sufficient that they could make annual payments towards a plan like this. And that's what Asset Care 4 would be. So here's how that would work. Everything is the same. There's a base policy, and then you can add on your continuation of benefits. And let's say we want to do an example of a $100,000 death benefit. Now this example is based on a joint policy with each person age 50 years old, 50, age 50. For the $100,000 death benefit, the annual premium is $1,758. And remember, this is a guaranteed premium that will never increase in cost. So at this benefit balance, that would provide $4,000 a month of long-term care per person. And then if we wanted to add on the lifetime benefit and also add a 3% compound inflation feature to this lifetime benefit, the annual cost is $2,858. If you add up this cost of $2,858 plus the $1,758, you're just under $4,600, right about $4,600 a year for a guaranteed premium that covers 2 people for unlimited long-term care, starting at $4,000 a month for 25 months, plus a lifetime feature that has 3% compound inflation at a guaranteed premium, so it will never increase. If they never use it for long-term care, there's a $100,000 death benefit. That way it takes away the use it or lose it sort of concept. If they ever need to cancel, there's a cash surrender value available out of the life insurance policy. So this has become a very favorable feature.
It's unbelievable. Yeah, it's really unbelievable. There's nothing out there like this. 2 people, lifetime benefit, $4,000 a year. It's just, we have to grab this for our clients now. It's unbelievable.
You're absolutely right. Thank you. It really is. It's unbelievable. It's a guaranteed premium that never increases in cost. You just can't get that in long-term care, plus a death benefit should you never use it in cash value. This is an excellent, excellent feature. We're kind of deeming this the new way to plan for long-term care. That's how popular this is and how fast-growing it is. Also, you can also do limited pays. Something that was very popular, as Alana can confirm, was on long-term care policies. People really like being able to do a 10-pay or a 20-pay. That way it's paid up after a certain point and you don't have to pay any more premiums. You can't get that in long-term care anymore, but you can do this on this plan. You can do that. You can have a limited pay. You can have it be paid up after 10 years or 20 years. So really great feature as well that's available in Asset Care 4. Okay, lastly, just take a minute here to discuss annuities.
James, yep. Can I interrupt you for a moment? We have a question the question is, when the insured has a claim, explain what happens to the premium for the rider and for the life insurance, please.
Okay, let's use this. Let's use Asset Care 4 for an example. Okay, let's say they're paying this policy. They have their $1,758 premium for the base policy, and then they have their $2,858 for the lifetime continuation. Now, one person needs to go on claim. They first access this 25-month balance, this $100,000 at $4,000 a month. When they're on claim and they're accessing this balance, the $1,758 premium is waived. So this has waiver of premium, but you have to make sure to elect the waiver of premium. And this value is including waiver of premium in there. So the $1,758 is waived while on claim. The $2,858 would continue to be paid while you're on claim from the base policy. So you would continue to pay the $2,858. Then, once you exhaust this $100,000, you exhaust this 25 months, and now you're on to the lifetime benefit, then at that point, the $2,858 premium would be waived while claiming. So that's the order. It depends on where you're on claim from first. While you're on claim from the base, that premium's waived, but you continue to pay the premium for the lifetime benefit. Then once you start taking benefits from the lifetime, then the premium is waived.
Okay, and we have one more question. It's the previous when we were talking about Asset Care 3, about using qualified money and how that interacts with RMDs. Okay,
the withdrawal on Asset Care 3, I'll just answer that real simply. That will satisfy the RMD requirements on that particular source of funds. So it will always be enough to cover the required minimum distribution cost. It actually will always be a little more, and any excess you can be used to count towards any RMDs on other qualified accounts that the client has.
Okay, thank you.
All right, no problem. I know we're running out of time here, so I just want to a minute here because this is a big item here. Now, some of you on this call may do annuities and some of you may not, but even if you do not, I want to assure you that just because this is an annuity we're going to discuss doesn't mean it will not pertain to you, because this is a great option available out there. A lot of clients have annuities, just in general. They just have annuities. It was a great savings tool, offered great interest rates just a few years back, offered benefits of tax deferral. So a lot of people have annuities, but they don't really have a huge use for them. A lot of annuities are just fixed annuities that are savings vehicles without an income plan, without an objective. It's just savings. And a lot of people will not use their annuities for anything because they know all that tax-deferred interest will then all of a sudden become taxable as soon as they take a withdrawal. So an annuity is an asset people have that is like a last resort source of funds to use for any reason. Well, if we could return that type of an asset into a very usable source for long-term care expenses, that's going to have great appeal to your clients. And one way we can do that is through leveraging. So if we were to do a 1035 exchange of someone's current annuity into one America's annuities, we can immediately leverage their annuity to be worth 2 times, 3 times the value should they ever need long-term care. So now we're having some better benefits, some more leveraging of their own money to help pay for long-term care. But it doesn't end there. There's also a tax benefit. This is due to the Pension Protection Act changed HIPAA laws that now allows for specific non-qualified annuities. So not any annuity, it has to be a specific annuity, which our annuities are. If you 1035 exchange annuity dollars into our long-term care annuity plan, all of the tax-deferred gain would be eligible to come out tax-free if withdrawn to pay for long-term care expenses. So you are literally showing your client a way to turn a taxable vehicle into a tax-free vehicle if the money is used for long-term care. Let me show you an example. Let's say somebody started an annuity way back in the day with $50,000. Over the years, it's earned $100,000 of tax-deferred interest. So today it's worth $150,000. Where that annuity resides today, if they were to withdraw funds from that annuity to pay for long-term care, that interest would come out first and it would be taxable. What we can show them, what we can do is this. Instead of holding the funds in that current annuity, do a simple 1035 exchange to a One America long-term care annuity, and now all $150,000 would be eligible to be withdrawn tax-free if used to pay for long-term care expenses. And that's just due simply to the fact of the Pension Protection Act rule that allows specific annuities to be withdrawn tax-free to pay for long-term care expenses. So qualified money doesn't work for this. It has to be a non-qualified annuity. But what a great story for clients to show them how to turn something that would normally be taxable for them into something tax-free. They're always going to want to hear that. And then on top of that, we add in the ability for leverage here. We're about out of time. I just want to kind of just stop there because Alana can always follow up with you on the annuities. Underwriting, I just want to touch on that. For the annuities, underwriting is very simple. It's just a phone interview. It's a short phone interview. It's about 15 minutes per person. Goes through health history, medications, also a cognitive section as well, just to make sure there aren't any cognitive issues. And so if they pass the phone interview, underwriting is complete, and that's it. So the annuities, very simplified process and very flexible. A lot of conditions that would lead to declines for long-term care can often get approved for the annuities. Now, the auto declines are still there. If you have Parkinson's, MS, ALS, cerebral palsy, Alzheimer's, all of those would still be automatic declines. But fibromyalgia, rheumatoid arthritis, cancers to some degree, a culmination of health issues can often lead to approval with the annuity product. So great source and solution for those.
And James, I've also gone through with asset care. I've been able to insure people that have been declined with traditional or the traditional life with long-term care. I've been able to get them approved with asset care, such as fibromyalgia, even a stroke. I even was the okay because the stroke was long enough ago. So
that's perfect. Yeah, that's perfect, Alana. That's a perfect segue to let's discuss the underwriting with asset care. So with asset care, underwritten a little bit differently. Now, you're going to have some clients that are healthy, and they don't necessarily need to go through a whole rigorous underwriting process. For those clients that don't really have much health issues, for those we can do a phone interview underwriting process. It's a little bit longer of a phone interview. It's about 30 minutes per person, and again, this goes through health history, also goes through medications and a cognitive section. And if approved by the phone interview, then underwriting is complete, and we're finished. So potential for quick turnaround process on asset care. However, people applying for this are in their 50s, 60s, and 70s. There's a good chance they just may have run across some health history. For example, they may have had cancers in the past, or as Alana had alluded to, maybe a stroke, or any other culmination of items. And they're not necessarily in a position where they're declinable. However, it's a little bit too risky for us to approve them by a phone interview. But we won't just decline them. What we'll then do is offer to take the next step to get their medical records, do a paramed exam if necessary. That way, we can review all the information, make sure we can take on that risk, and put them in the best position to be able to offer them coverage. And because we can do that, because we can review medical records, as Alana said, we can often approve conditions that were often led to a decline. In those examples, stroke, some cancers, fibromyalgia, rheumatoid arthritis, we're a lot more flexible with a lot of those conditions. So there's a good chance, just because someone was declined for long-term care does not exactly mean that they would be declined with our products as well, whether it's pediatric or annuity care.
Absolutely. I encourage everyone, if you've had a decline for long-term care, let's contact me, send me the information. You'll get my contact information at the end of this webinar. And let's look at it. I have been very successful turning declines into approvals using One America products.
Great, great. Well, I'm going to wrap up there. Alana, I'd like to turn it back over to you with any closing comments you'd like to add.
Well, I have one more question from an attendee. This is what happens if you are a U.S. citizen and you reside outside the country and you are willing to come back to the country and sign in the United States. Is that doable? Will One America work with that type of applicant?
You have to reside in the United States. So you do have to have a permanent residence in the United States in order to apply. Now, so if you are a U.S. Citizen and you have a permanent residence here and you apply and you have your policy, and then later on in life, your path leads you to live internationally, you'll still have your plan, you'll still have full benefits available in the U.S., but there will be restrictions on the benefits internationally on the policy. For a California policy, what it is, you'd have 12 months of long-term care benefits internationally. If you're in any other, if your contract is issued in any other state other than California, what you would have is the full death benefit balance to use internationally, but it would be at half the monthly benefit. Your monthly benefit would be half, but your benefit period would last twice as long.
Okay, thank you for addressing that. Thank you so much. I love using your products. I think the solutions are great. We can use qualified money. We could have a second to die. We're not limiting the benefit. If there's two people associated with this policy, it's awesome. There's unlimited coverage, and you can add inflation for unlimited lifetime benefits or doubling the death benefit and adding inflation. So it's just awesome. I love the underwriting. Thank you so much for presenting this amazing product.
Thank you. Appreciate the opportunity.
Okay. Thanks, James. So, everybody, it's Long-Term Care Awareness Month, and this is the time to get people thinking. So my question I'm presenting to you is, how do you approach this? How do you start the conversation? When you meet with any of your clients, you know that insurance are walls of protection. So the first question you ask them is, what is your plan? And as James mentioned before, if they do have a plan, the plan is to use their hard-earned money or their retirement portfolio they've been wanting to retire on. So take the time to ask them, what is your plan? Who will take care of them? Each other? Their children? Will this person become your full-time caregiver? How is that going to work? Where do they want to live when they need care? Stay in their home? Assisted living? Go to a Medicaid facility? Or are they willing to move into the home with their children? Or are their children willing to come and live with them? These are the questions you can ask, open-ended. Don't give them the answer. Let them think on their own. And I assure you they're going to want an answer that does not involve their immediate family. So I hope you enjoyed today's presentation. There are ways of addressing long-term care other than the traditional long-term care product. That doesn't mean traditional long-term care is not the answer for your client, but if it's not, if they only have qualified money, if they want a second to die, if they're looking for lifetime benefit, give me a call or you can email me. Give me the scenario, let's brainstorm together and come up with an answer that resonates well for you and your client. Thank you very much for attending, and I will be forwarding through an email this presentation and some materials that might help you. Thanks again, everyone.